According to Jim Rogers, the biggest of recession is coming soon. And he says the next market crash will be the worst. He is sitting on cash and he's a major finance visionary in the West. He is predicting that the market is at the peak and will come crashing down soon. But how soon? Cash itself is a valuable asset that can help at the times of crisis. So cash, like equity, commodities or debt instruments, is an important asset class. But how do you invest in this asset class called cash and how do you benefit from it? Predicting the future of the market is very tough, even for the best in the business. During COVID-19 crisis, many respected investors and economists made bold predictions, but most of them were wrong. Let's look at a few examples. David Stockman said the market would drop 50% and stay down for a very long time. Instead, it bounced back quickly. Nouriel Roubini warned about a global recession which will be worse than the 2008, possibly leading to a greater depression. Thankfully, even that did not happen. Peter Schiff predicted that the economy would be destroyed by inflation, but then the markets recovered faster than expected. John Hussman, Jeff, and George Soros all expected a very prolonged bear market, yet the stock market kept going up. Albert Edwards and David Rosenberg thought the market was overestimating the central bank's support. But again, the market proved them wrong. The key takeaway: even highly acclaimed investors can get the market timing wrong. The market is very unpredictable, and trying to time it based on predictions can lead to costly mistakes. That's why it is often better to stay invested for the long term instead of making decisions based on short-term forecast. Markets can surprise everyone, even the experts. Even closer home, the then RBI governor predicted a global market crash 10 years ago. He might still be right, but the timing is impossible to predict. It's been 10 years since his warning. However, a crash will happen someday, as we have seen in the past. Every few years, a big crash is likely to happen to correct market excesses. And when it does, many experts will claim they predicted it right, simply because they made similar predictions earlier. So we will look at 3 data points to see how to plan a portfolio to withstand. Let's see a crash analysis made by Funds India. The fall is very messy and you cannot figure out this event until it has occurred. Imagine you were lucky to exit here before a big fall. If you had exited right before the fall and waited to enter back, the market is up 7%. Is this the start of a recovery? Should you enter back? Now you enter and it started falling again. The market is up 12%. Is this the start of the recovery? You enter again. Oops, it started falling again. The same story continues several times over the next 1 year. Now when the 8th time the same pattern of a quick upside happens, what would be your reaction? One would say, no worries, I've already seen this before. It will fall further, let me wait. The market has tricked our pattern-seeking brain into feeling complacent and overconfident. It makes it hard to see the real turning point. And here is the killer. Even the recovery is not smooth. It has made several false decline, playing with our mind, always keeping us confused in the short term. To add to the pain, the extreme volatility of weekly returns. And that's the anatomy of a crash that cannot be managed by using the cognitive part of our brain. The second illustration is this. Let us say you believe you are an ace investor who wants to invest after every 10% crash or a 20% crash. You are the one who does investments in a disciplined manner every month through an SIP. What returns would you make if you had invested after a big crash alone? Weekend Investing had shared this data based on their research. If an investor had invested every month for the past 34 years, he would have generated a 12.5% CAGR. A person who only invested whenever the markets crashed by 10%, he has generated 12.64%. Now, if you were an investor who invested only when the market crashed 20%, you would have generated a similar CAGR of 12.73%. But the real challenge is that although all the investors got similar returns, the person who invested at 20% fall got only 123 instances to invest in the past 34 years. The person who invested whenever the market declines 10% got 198 such instances to invest. However, the person who invested every month had about 410 instances to invest. So if all the investors had invested the same amount, the one who invested regularly created 2 times more wealth compared to the one who invested only at a 20% decline. The investor who invested at 10% crash made 35% more wealth than the one who invested at 20% crash. However, going through a crash is an emotional crisis. No one can find it easy to see his portfolio go down. Hence, some reasonable way to rebalance your portfolio, sell or hold cash, would be using a valuation metric. The equity valuation index says if the market is in an expensive zone or if it is in a cheaper zone. The challenge is that this is a bit subjective. One can consider booking some profit in the red zone and invest in cash. And in the green zone, one can invest the cash into equity. However, this is not a foolproof way, as markets in the red zone can continue to give higher returns, and markets in the green zone can remain down longer, testing the patience. Cash offers liquidity, meaning it's easily accessible for emergency or for other opportunities. It also adds stability to the portfolio during volatile times. However, holding too much cash has a downside. In a bull market, you may miss out on the gains and inflation reduces its value over time. While cash is safe, keeping too much of it can limit your potential growth for the future. Balancing this is the key. A multi-asset investment approach in equity, bonds, cash, commodities can give peace of mind to some. However, it will look bad decision if the markets continue to go up for a long time. Investing is a business of regret. You regret either investing too much if the market corrects and goes down, or you regret investing less if the market goes up. The key is to stay disciplined, avoid emotional decisions, and remember that long-term success comes from staying invested through both ups and downs of the market. If you found this video helpful, don't forget to like, share, and subscribe for more such insights. Do comment with your own thoughts on how you would handle a market crash.